In the vocabulary of the modern trader, few concepts are as fundamental as support and resistance. They are the invisible lines on a chart, the price levels where the great battles between buyers and sellers are fought, where trends are born, and where they ultimately meet their demise. The speculator who can correctly interpret these levels possesses a powerful strategic advantage. Yet long before these terms became a common part of the market's lexicon, one man had already mastered their underlying principles with a depth and a precision that remains unparalleled. That man was Jesse Livermore, and what he called pivotal points were the true original secrets of support and resistance. This is not a simple lesson in drawing lines on a chart. It is a deep dive into the mind of a master, an exploration of how he read the psychological drama of the market at these critical price junctures. Livermore did not see support and resistance as static, lifeless barriers. He saw them as living, breathing expressions of the market's collective will, the points of maximum tension and, therefore, of maximum opportunity. His strategy for trading these levels was universal, a powerful and adaptable methodology for extracting profits from the market's great swings, in bull and bear conditions alike. He knew that the speculator who understands these secrets no longer sees the market as a random, chaotic entity. He sees it as a structured, logical battlefield with clear and discernible front lines. He knows where to expect a fight, he knows the signs of a decisive victory, and he knows with a high degree of certainty which direction the market is likely to move after the battle is won. This is the science of reading the market's intentions, a science built upon the timeless principles of support and resistance. The journey of a speculator is often a solitary one, marked by the intense pressure of making high-stakes decisions alone. It is easy to lose perspective, to be swayed by the noise of the crowd, or to falter in your discipline after a series of setbacks. This is why we created this channel, to serve as a constant source of these timeless principles, a place you can return to, not just to learn, but to recalibrate your mindset. If you are committed to the path of a professional speculator, subscribe to our channel and return to these lessons. They are here to provide not just knowledge, but reinforcement and perspective when you need it most. To understand Livermore's method, we must first translate his language. What the modern trader calls a resistance level, Livermore typically referred to as a pivotal point at a previous high, or the upper boundary of a great trading range. This was a price level where, on a previous advance, the selling pressure had been strong enough to halt the upward move. It represented a ceiling, a zone of supply where sellers were known to be waiting. The existence of this level was a fact, a piece of historical data that had to be respected. Symmetrically, what we now call a support level, he saw as a pivotal point at a previous low, particularly the low point of a natural reaction within a great bull move. This was a price level where, on a previous decline, the buying pressure had been strong enough to absorb all the selling and turn the tide. It represented a floor, a zone of demand where buyers were known to be present. The amateur looks at these levels and sees them as places to gamble. The professional sees them as places to gather information. Livermore paid immense attention to periods when a stock would trade for a considerable time between two of these points in what he called a trading range. He provided the example of a stock holding between $22 and $28. In modern terms, $22 was the support and $28 was the resistance. He considered the area between these two lines to be a fool's playground, a zone of uncertainty where the next great move had not yet declared itself. To trade within this range was to be whipsawed by meaningless, unprofitable fluctuations. The real opportunity was not inside the range, but at its boundaries. This entire concept was unified under his great central philosophy of the line of least resistance. While a stock was contained within its trading range, the line of least resistance was neutral, undefined. But the moment the stock decisively broke through its resistance level, the path was clear. The line of least resistance was now unmistakably upward. Conversely, a decisive break below the support level was an equally powerful signal that the path of least resistance was now downward. Now, Livermore was the supreme practitioner, the man who could read the effect of these levels on the tape with unmatched intuitive skill. But one of his great contemporaries, Richard Wyckoff, dedicated his life to a different but complementary task, to codify the cause. While Livermore was the master speculator, acting on the tape's immediate message, Wyckoff was the master analyst, mapping the unseen campaigns of accumulation at support and distribution at resistance that are the true source of all major market moves. Wyckoff shows you the engine room. Livermore shows you how to pilot the ship. To truly understand the internal mechanics of the market, the logic of supply and demand that Livermore himself mastered intuitively, we invite you to subscribe to our new channel, Richard Wyckoff Trading Methods. The link is in the description below. This brings us to the first great secret of Livermore's strategy, a principle that stands in stark opposition to the methods of the average trader. The amateur looks at a support level and sees a bargain. He buys at support, anticipating a bounce. He looks at a resistance level and sees a top. He sells short, anticipating a rejection. This is a game of prediction, of guesswork. Livermore's method was the polar opposite. He did not anticipate. He waited for confirmation. The first secret is this: never anticipate the hold. Always trade the break. He was not interested in guessing whether a support or resistance level would hold. He knew this was a low probability bet, an attempt to catch a falling knife or to stand in front of a rising locomotive. His entire strategy was built upon waiting for the market to prove that one side of the battle had been decisively won. He did not buy a stock as it approached its resistance level. He bought it only after it had decisively broken through it. He did not short a stock as it fell to support. He shorted it only after it had decisively broken below it. He wrote with the force of an unbreakable commandment, "Do not be too anxious to get into it. Wait and watch the action. Have patience and wait until the stock becomes active, until it makes a new high." The breakout above the resistance level, the pivotal point, was his only legitimate signal to buy. It was the market's own announcement that the great wall of selling pressure had finally crumbled, that the buyers were in complete control, and that the line of least resistance was now clear for a major advance. But it was not enough for the price to simply poke its head above the line. This is where the amateurs are so often trapped by false breakouts or fake-outs. Livermore's second great secret was his mechanical rule for confirming the validity of the break. The stock did not just have to cross the pivotal point. It had to do so with power and conviction. His rule was that a true breakout was only confirmed after the price had moved a margin of at least 3 full points beyond the resistance or support level. This 3-point rule was his ultimate filter, his mechanical method for distinguishing a genuine, institutional-led move from a flimsy, speculative flurry. A stock that could only rally a point or two beyond a major resistance level before faltering was a stock that was advertising its own weakness. It was a trap. But a stock that could surge 3 or more points beyond that level on increasing volume and hold those gains was a stock that was providing the highest possible confirmation that a new and powerful trend was underway. It was only then, with this confirmation in hand, that he would commit his capital with force. Having established the foundational secrets of Livermore's approach to translate support and resistance into the dynamic language of pivotal points and to act only upon a confirmed break, we now arrive at the operational strategy. It is not enough to simply identify the correct moment to act. The professional speculator must have a clear and powerful plan for capitalizing on that moment, a methodology for building and managing a position that is as potent in a great bear market as it is in a great bull market. This was the source of Livermore's legendary versatility. He was neither a permanent bull nor a permanent bear. He was a master of the prevailing trend, and his strategy was a perfect symmetrical machine for profiting from it, no matter which direction it moved. Let us first examine his strategy for a bull market, for the scenario where a stock has decisively broken through a major resistance level. The amateur, having seen the breakout, is often paralyzed by the thought that he has missed it, that the price is now too high. Livermore knew this to be a fatal error in perception. The breakout was not the end of the move. It was the very beginning. The price was not high. It was now in a position of proven strength. His rule was absolute. He became a buyer only after the stock made a new high. He was not a bargain hunter. He was a strength follower. His method for building a position was a masterclass in calculated aggression. He would not commit his entire line at once. The first break of the pivotal point would justify an initial probe. If that probe showed an immediate profit, confirming the validity of the move, he would then begin to pyramid his position. His rule was unwavering. Each succeeding purchase must be at a higher price than the previous one. He would add to his line on a rising scale, his commitment growing in direct proportion to the market's own confirmation of his judgment. This is the art of averaging up, a practice so contrary to the amateur's instincts, yet so fundamental to professional success. The speculator is reinforcing success, not failure. He is letting the market's own momentum finance his increased exposure. With each new purchase, his stop loss would be trailed up, protecting his initial capital and then progressively his accumulated paper profits. He was building a fortress of profit brick by brick on a foundation of proven strength. Once his full line was established, his strategy shifted from accumulation to management. This was the art of sitting tight. He knew the big money was made in the big swing, and he had the courage to hold his position through the minor, nerve-wracking but perfectly normal, natural reactions. His confidence was not based on hope, but on the soundness of his initial premise, which had been confirmed at every step of his pyramiding process. He would not be shaken out by the meaningless noise of the market. He would hold, with intelligent patience, until the market itself signaled that the great move was complete. Now consider the perfect, beautiful symmetry of his approach. His strategy for a bear market, for a stock that has decisively broken below a major support level, was the exact mirror image. The amateur looks at a stock that has collapsed through a support level and sees a bargain. He tries to catch the falling knife, an act of hope that almost always ends in a bloody financial wound. Livermore saw the opposite. He saw not a bargain, but a confirmation of profound weakness. The break of support was his signal not to buy, but to sell short. He would not short a stock on a rally, hoping for it to turn down. He would short it as it was making a new low after it had broken its pivotal point of support. He was aligning himself with the now proven line of least resistance, which was unmistakably downward. Just as in a bull market, he would not commit his full line at once. He would begin with a probe, an initial short position. If the stock continued to decline, showing him an immediate profit, it was his confirmation to proceed. He would then pyramid his short position, but on a declining scale. His rule was the perfect inverse of his bull market strategy. Never make an additional sale unless it is at a lower price than the previous sale. He was averaging his short position down, adding to his line as the stock demonstrated increasing weakness. With each new addition, he would trail his stop-loss downward, protecting his profits from the sharp, violent rallies that so often characterize a bear market. His entire operational framework was built on this beautiful, logical symmetry. In a bull market, he bought strength, and he bought more of it as it became stronger. In a bear market, he sold weakness, and he sold more of it as it became weaker. He was not a man of fixed opinions, but a man of flexible, adaptive strategy. His loyalty was not to the bull or the bear side, but to the right side, the side that was in harmony with the market's primary underlying force. The secrets of support and resistance then, as Livermore mastered them, were not about predicting whether a level would hold. They were about having a complete, disciplined, and symmetrical plan of action for when a level inevitably broke. It was the secret of waiting for confirmation, of pyramiding a winning position, and of having the courage to ride the trend no matter which direction it was headed. It was a universal strategy, as powerful for the bear as it was for the bull. This is what separates the professional, the 10% who can profit in any market, from the amateur, the 90% who are almost always one-trick bulls, who make money in a rising market only to give it all back, and more when the great trend finally turns. Livermore's method was a plan for all seasons. It was a testament to his profound understanding that the speculator's job is not to predict the market, but to align himself with its revealed truth, and to have a sound, business-like plan for profiting from that truth. To truly understand the mind of the man who mastered these principles, to witness the epic market battles where this very plan was put to the ultimate test. The essential chronicle remains Edwin Lefebvre's 1923 masterpiece, Reminiscences of a Stock Operator. This is not merely a book. It is a deep psychological portrait of a master at work, a narrative that gives life and context to every one of these timeless rules. For those committed to this study, a link to the edition featuring a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader, is provided in the description below.